Hey everyone, today we're going to tackle one of the trickiest parts of trading, something that honestly trips up just about everyone: managing risk. We're going to look at a much smarter, more flexible way to set your stop loss, getting away from those rigid, fixed numbers by using a really cool tool called the ATR indicator. So let's just get right into it. This is the question, isn't it? Every single trader, I don't care if you're brand new or you've been doing this for years, asks this. You find the perfect entry, you're all set to go. But where on earth do you put that safety net? You put it too close, and some random, meaningless market spike knocks you out of a good trade. Put it too far away, and you're staring down a massive loss. It's just a constant headache. And a huge reason for that headache is that we often rely on these fixed rules. I'll always rest 2%, or I'll just stick it 50 pips below my entry. The big problem with that is the market has a personality, and that personality changes all the time. Some days it's calm, it's quiet. Other days, it's an absolute roller coaster. A fixed stop loss just completely ignores that reality. So it only makes sense, right? If the market is dynamic, our risk management should be dynamic too. And that brings us to the solution we're going to break down today: the average true range indicator, or ATR for short. This is how we start to actually listen to what the market is telling us about its current mood. Okay, so what exactly is this ATR thing? Don't let the name fool you. It's actually pretty simple at its core. It's an indicator that just measures how much an asset's price is moving around, on average. The key here is that it's not telling you which way the price is going, up or down. It's just telling you about the energy, the intensity of the movement. It's all about volatility. Here's probably the best way to think about it. Imagine the ATR is like a special ruler, but instead of measuring inches or centimeters, it's measuring market noise, or its volatility. So when the market is really loud and choppy, making big swings, the ATR ruler gives you a high reading. And when things are quiet and stable, the ATR reading is low. It's really that straightforward. All right, theory is one thing, but how do we actually use this ruler? This is where we get practical. Let's break down how this whole concept turns into a really simple but powerful formula for setting a smarter stop loss. The whole thing really just boils down to 3 easy steps. First, you just glance at your chart and find the current ATR value. Pretty much every trading platform has this built right in. Second, you choose what's called a risk multiplier. We'll just call it X. This part is personal. And third, you just plug those 2 numbers into the formula with your entry price. That's it. And here is that formula. It looks simple, and it is. So for a long position where you're buying, your stop loss is your entry price minus your multiplier times the ATR. For a short position where you're selling, it's your entry price plus that same calculation. The plus or minus just depends on which side of the market you're on. Now that multiplier, that X, is really the key. Think of it as your personal risk dial. You get to decide how much room you want to give the trade. A pretty common range to work with is somewhere between 1.5 and 3. A lower number, like 1.5, gives you a tighter stop, which might be good for a quick scalp. A higher number, like 3, gives the trade a lot more room to breathe, which is probably better for a longer-term swing trade. It's how you customize this whole thing to your own trading style. Let's just walk through a super quick example so this all clicks. Let's say you buy a stock at exactly $100. You look down at your ATR indicator and it reads $2. And you decide, okay, I'm going to use a multiplier of 2. So you just do the math. 2 times the ATR of $2, that gives you $4. And since you're in a long position, you subtract that from your entry. $100 minus $4, your stop loss is $96. See? Simple as that. Okay, so we know how to do it, but why is this so much better than just picking a percentage out of thin air? Well, this really gets to the heart of the matter, the core benefit: flexibility. This right here is the magic of it all. When the market is going crazy, super volatile, the ATR value is going to be high. That automatically makes your stop loss wider, which gives your trade the space it needs to move without getting stopped out by all that noise. But on the flip side, when the market is calm and stable, the ATR is low. This automatically gives you a tighter stop loss, letting you lock in and protect your profits much more closely. Your risk is now adapting in real time to what the market is actually doing. We've covered a good bit of ground here, so let's just pause and pull it all together. What are the absolute key things you need to remember from all this? So if you walk away with anything today, let it be these 3 things. First, ATR is just your ruler for volatility. That's all it is. Second, that simple formula, entry price plus or minus your multiplier times the ATR, is your tool for a dynamic, data-driven stop loss. And third, And this is the most important part. This whole method forces your risk strategy to actually adapt to what the market is doing right now, not some random rule you made up last week.
So I'll just leave you with this final question to think about. Is your current risk strategy based on some fixed, rigid rule, or is it actually listening to what the market is telling you? Using the ATR is one of the best ways to start having that conversation.